From the outside, trading looks incredibly simple. A person sits in front of a screen, watches a few charts, clicks a button, and money appears to move almost magically. Social media is full of screenshots showing massive profits, traders celebrating huge wins and luxury lifestyles supposedly funded by a few smart trades. To someone watching from the outside, it seems almost too easy. Just learn a strategy, follow a few indicators, buy when the chart goes up, sell when it goes down, and the money will start flowing. This illusion is powerful because it convinces thousands of people every day that trading is simply a skill problem. They believe that if they just find the right strategy or the perfect indicator, success will follow automatically. What most people don't realize is that trading has very little to do with the clean, logical world they imagine. The charts may look technical, strategies may look mathematical. Behind the screen, something very different is happening. Trading is not just analysis, it is psychological warfare, and the battlefield is your own mind. Every trader begins the same way, filled with curiosity, enthusiasm, and a powerful sense of possibility. They open their first trading account, carefully type in the amount for their first deposit, and stare at the balance on the screen. It might not be a huge amount of money, but in their mind, it represents opportunity. Small number could grow, it could multiply, it could become the beginning of financial freedom. With a mixture of excitement and nervous energy, they open their first chart. Lines cross, indicators flash signals. At first, it all feels confusing, but also strangely exciting. They watch a few videos, read a few posts online, maybe follow a strategy someone recommended. Then comes the moment every new trader remembers forever. The first trade. The heart beats a little faster as the order is placed. Suddenly the trader is no longer just watching the market. They are part of it. Every tiny movement in price now matters. The chart ticks up and down, sometimes moving against them, sometimes moving in their favor. The seconds feel longer, the emotions become stronger, and then something incredible happens. The trade goes into profit slowly at first, then a little more. Numbers on the screen turn green, the balance increases. It might not be a huge amount, but in that moment, it feels enormous. The trader feels a rush of excitement that is difficult to describe. The brain releases dopamine, the same chemical that appears during moments of reward and victory. Watching the profit grow creates a powerful emotional reaction. It feels like validation, proof that the system works, like proof that they are smarter than the market. The excitement grows quickly. If one trade can make money, then maybe many trades can make even more. The imagination begins to run wild. Suddenly, the future looks completely different. Financial freedom no longer feels like a distant dream. It feels close, achievable, almost certain. The trader starts thinking about what life could look like if this continues. No boss, schedule, just charts, trades, and the freedom to make money from anywhere in the world. This is the moment where the illusion becomes strongest. First win convinces the mind that the path is easy. It creates confidence, but not the kind of confidence built on experience. It is fragile confidence built on a single success, and fragile confidence is dangerous. The trader begins taking more trades. Sometimes they win again, which only strengthens the belief that they have discovered something special. Each green trade feels like confirmation that they understand the market, connects trading with reward, excitement, and possibility. But markets have a way of testing that belief. Eventually, without warning, the first serious loss arrives. Might look small, just a red number instead of a green one, but the emotional impact is completely different. Instead of excitement, there is confusion. Trader looks at the chart and wonders what went wrong. The setup looked perfect. The strategy said it should work. Yet the trade moves in the opposite direction and grows slightly larger. Doubt begins to creep in. Maybe the entry was wrong. Maybe the timing was off. Maybe the market is just being unpredictable today. The trader tries again, hoping to recover the loss quickly. Sometimes the next trade loses too, and the emotional shift becomes impossible to ignore. Confidence that felt so strong just hours earlier begins to crack. Confusion slowly turns into frustration. Frustration turns into anger. The trader starts staring at the screen, searching for answers, trying to understand why something that looked so easy suddenly feels impossible. The emotional roller coaster begins quietly at first, but it accelerates quickly. Trades bring excitement and hope. Losing trades bring stress and self-doubt. The mind begins swinging between these extremes. Instead of calmly following a plan, trader becomes emotionally attached to every movement of the chart. Every candle feels personal. Every loss feels like a mistake that must be corrected immediately. The market stops feeling like a system of probabilities and starts feeling like an opponent that needs to be defeated. Is the moment when most traders unknowingly step onto a path that is far more difficult than they ever imagined. Trading is not just about reading charts or understanding indicators, about controlling the most powerful emotions the human mind can produce: greed, fear, regret. These emotions do not appear all at once. They grow slowly, trade by trade, win, by loss. And once they take hold, they begin influencing every decision the trader makes. Started as a simple attempt to make money from the market slowly transforms into something much deeper and much more challenging. The charts remain the same, strategies remain the same. The mind behind the screen begins fighting an invisible battle that most beginners never expected. Once a trader steps onto this emotional roller coaster, the ride rarely slows down. Every new trade carries the promise of victory and the threat of failure at the same time, pulling the mind deeper into a cycle of hope, pressure, and uncertainty where the next decision always feels like it could change everything. The most dangerous thing about trading is not the market itself, is the emotional cycle that quietly takes control of almost every trader who enters this world. In the beginning, nobody notices it. It feels like normal excitement, normal curiosity, normal ambition. But beneath the surface, a powerful psychological pattern is forming. And once a trader enters this cycle, it becomes incredibly difficult to escape. Every trader in the world moves through the same emotional stages, often without realizing it. The cycle usually begins with excitement. Discovering trading feels like uncovering a hidden opportunity that most people never see. You learn that financial markets move every day, creating chances to profit from price movements. The idea feels powerful. Instead of working for money in the traditional way, you could potentially grow your wealth from a laptop, analyzing charts, decisions based on market behavior. The possibilities seem endless. You begin watching videos, reading strategies, exploring indicators, and learning the language of trading, like support, resistance, breakout, and risk, to rewards start becoming familiar. Every new concept feels like another piece of a puzzle that is slowly revealing how the market works. At this stage, everything feels positive. You imagine yourself mastering the charts, predicting movements, and building a profitable system that gives you financial freedom. The next stage arrives. Euphoria usually appears after the first few winning trades. Suddenly, the theory becomes reality. You place a trade, the market moves in your direction, and the numbers on the screen turn green. The profit might be small, but the emotional impact is huge. Your brain interprets the win as confirmation that you are on the right path. Strategy works. The market makes sense. The effort you put into learning is paying off. Excitement from the discovery phase now turns into something stronger. Confidence begins to build. You start believing that success is not just possible, it is inevitable. This is the stage where many traders feel like they have cracked the code. They begin imagining how fast their account could grow if they continue trading this way. They calculate future profits in their mind, seeing their balance multiply week after week. The belief that trading can change their life becomes stronger with every winning trade. Hidden inside this euphoria is the beginning of the next stage, overconfidence. Once a trader believes they understand the market, behavior slowly begins to change. Risk starts increasing without them fully noticing. Trades become slightly larger. Stop losses become slightly wider. Rules that once felt important begin to feel optional. After all, if the strategy works and the market makes sense, not push a little harder and accelerate the profits. The trader starts trusting their instincts more than their plan. They enter trades earlier. They stay in trades longer. They begin feeling like they can read the market's intentions. This is where the emotional balance begins to shift. Markets have a way of reminding traders that certainty does not exist. Losses start appearing. At first, they seem harmless, normal losing trades that happen in every system. But as they accumulate, a new emotion begins to emerge. Anxiety. Trader starts looking at charts differently. Instead of seeing opportunities, they begin noticing uncertainty. Entries that once felt obvious now feel questionable. Creeps into the decision-making process. Maybe the strategy isn't as reliable as it first seemed. Maybe the market conditions have changed. The trader made mistakes without realizing it. Uncertainty leads directly into the next stage, denial. Losing trades become harder to accept. When a trade moves against the position, the trader hesitates to close it. Instead of following the original plan, they hold the trade longer, hoping the market will reverse. The mind starts creating reasons to stay in the position. Maybe the price will bounce from support. Maybe the trend will resume. Maybe the next candle will reverse everything. The loss sits on the screen, growing slowly larger. Closing it feels emotionally painful. Admitting the trade was wrong feels like admitting personal failure. So the trade waits, hoping the market will come back and erase the mistake. Sometimes it does, and when it does, the trader feels relieved, even rewarded for ignoring the plan. But Many times the market keeps moving in the opposite direction, and that leads to fear. Fear changes how a trader behaves in a completely different way. Now, instead of holding losing trades too long, the trader starts closing winning trades too early. The moment a trade shows a small profit, the trader quickly exits, afraid the market might reverse again. The balance between risk and reward begins collapsing. Small profits are taken quickly while losses remain large. Confidence continues fading, replaced by tension and hesitation. The trader begins feeling like every decision might be wrong. Emotional pressure eventually leads to one of the most destructive stages of all, revenge trading. After several losses, frustration builds to a point where patience disappears. The trader stops thinking calmly and begins trying to recover everything immediately. Position sizes suddenly increase. Trades are entered quickly without proper analysis. The goal is no longer to follow a system, but to win back the lost money as fast as possible. Each trade becomes an attempt to erase the previous mistake. Emotional urgency almost always makes the situation worse. Losses grow larger. The account balance starts dropping faster. And as the numbers fall, trader enters the final stage of the cycle, desperation. At this point, confidence is almost gone. The balance that once represented opportunity now looks like a reminder of failure. Trader stares at the shrinking account, wondering how everything went wrong so quickly. The excitement that once fueled every trade has turned into stress and disappointment. The cycle rarely ends here, because even after reaching desperation, many traders continue trading hoping that one perfect trade will fix everything. They search for new strategies, new indicators, new signals, believing the problem must be technical. But the truth is far more uncomfortable. Most traders believe their biggest problem is strategy. They think they just haven't discovered the right system yet. But the real problem is rarely knowledge. It is psychology. Traders usually know what they should do. They know they should control risk, follow rules, and remain disciplined. The challenge is that emotions slowly take control of those decisions. Fear changes exits. Greed changes position size, delays losses. Anger creates reckless trades. And by the time a trader realizes what is happening, the emotional cycle has already pulled them deep into a pattern where every decision feels heavier. Every trade feels more personal. Every attempt to recover only tightens the grip of the same psychological forces that quietly guide traders from excitement to desperation again and again, while the market continues moving forward completely indifferent to the emotional battles happening behind the screen. And the trader remains trapped in the cycle, still believing the next trade might finally be the one that changes everything. One of the most uncomfortable truths about trading is that the greatest obstacle most traders face is not the market, the strategy, or even the level of knowledge they have. The real obstacle is the human brain itself. The way the human mind evolved over thousands of years is perfectly designed for survival in the physical world. But ironically, that same design makes trading incredibly difficult. To understand why so many traders struggle, you have to understand something deeper than charts and strategies. You have to understand how the brain reacts to risk, uncertainty, and reward. Long before financial markets ever existed, human brain evolved to help people survive in dangerous and unpredictable environments. Early humans had to constantly watch for threats, search for food, and make quick decisions that could mean the difference between life and death. Because of this, the brain developed three powerful instincts that guided human behavior for thousands of years. The first instinct is the ability to detect and avoid danger. The brain is extremely sensitive to anything that could cause harm, and when it senses risk, it immediately activates a stress response designed to protect the body. The second instinct is the desire to seek rewards. When humans find food, safety, or success, brain releases chemicals like dopamine that create feelings of pleasure and satisfaction. This reward system encourages people to repeat behaviors that lead to positive outcomes. Third instinct is the need for certainty. The brain prefers situations where outcomes are predictable and understandable. When people know what will happen next, the brain feels safe and relaxed. When outcomes are uncertain, the brain becomes alert and cautious. These instincts helped humans survive for thousands of years. They create a powerful conflict when applied to trading financial markets, setups, or constantly changing strategies. But the traders who finally step off the emotional roller coaster usually make a different realization. Understand that the real transformation begins with changing their relationship with outcomes. The first step is learning to detach from individual results. The biggest psychological traps in trading is judging your ability based on a single trade, a single day, or even a single losing streak. When traders measure their success this way, every small outcome feels extremely important. A winning trade creates excitement and confidence. A losing trade creates frustration and self-doubt. Constant emotional swing makes it almost impossible to stay disciplined. Professional traders avoid this trap by focusing on the process rather than the outcome. Instead of asking, "Did this trade make money?" they ask a different question. "Did I follow my system correctly?" When the focus shifts to execution rather than results, emotional pressure begins to fade. A losing trade that follows the system is still considered a good trade because it was executed correctly within a probability-based plan. The next important step is accepting losses as a natural part of trading. Many beginners enter the market believing that successful traders somehow avoid losses most of the time. Belief creates unrealistic expectations and makes every loss feel like a failure. But the truth is much simpler. Losses are not a sign that something is wrong, are the cost of participating in the market. Just like any business has expenses, trading also has unavoidable costs. Professional traders understand this deeply. When a loss occurs, they do not treat it as a personal mistake or a reason to panic. Instead, they see it as a normal part of a larger statistical process. This acceptance removes a huge amount of emotional pressure and prevents traders from making impulsive decisions designed to fix a loss immediately. Once a trader accepts the reality of losses, the next step is creating strict rules that guide every decision. Rules are one of the most powerful tools for protecting traders from their own emotions. Without rules, decisions are made in the heat of the moment, influenced by fear, greed, or frustration. But with clearly defined rules, the decision-making process becomes structured and consistent. Every serious trading system needs several types of rules. Entry rules define exactly when a trade should be opened. Exit rules define when profits should be taken or losses should be closed. Position sizing rules determine how much capital can be exposed on any single trade. And daily limits define when trading should stop for the day after reaching certain profit or loss thresholds. These rules act like guardrails that keep traders from drifting into emotional behavior. When the rules are clear and consistently followed, the trader does not need to constantly debate every decision. The system provides the structure. Another powerful change that many successful traders make is reducing the amount of time they spend staring at charts. It may sound surprising because beginners often believe that watching the market all day will improve their performance. In reality, the opposite is often true. The more time traders spend watching every tiny movement in price, the more emotionally involved they become. Small fluctuations begin to feel meaningful, even when they are simply normal market noise. Constant exposure to price movement triggers emotional reactions that can lead to impulsive trades or premature exits. Many experienced traders intentionally limit their screen time to protect their mindset. They analyze the market, set their plans, and then step away instead of monitoring every second of price movement. Sometimes the most disciplined decision a trader can make is choosing not to trade at all. Waiting for the right conditions requires patience, but it also prevents unnecessary losses caused by boredom or impatience. Ultimately, final step in escaping the emotional roller coaster is developing emotional discipline. This is the skill that quietly separates profitable traders from those who struggle for years. Emotional discipline is not about eliminating feelings entirely. Fear, excitement, and frustration will always appear during trading because they are natural human reactions. The difference is that disciplined traders do not allow those emotions to control their behavior. They recognize the feelings. They continue following their system regardless of how they feel in the moment. Over time, this discipline becomes stronger through repetition and experience. The trader learns that patience often produces better results than constant action. They learn that consistency matters more than excitement. They learn that controlling risk is more important than chasing big wins. While many traders enter the market searching for adrenaline and fast profits, the ones who truly succeed are usually the ones who move in the opposite direction. They stop chasing excitement and begin chasing stability. They build routines, follow structured systems, and focus on long-term consistency rather than short-term thrills. And as this mindset becomes stronger, something interesting begins to happen. The emotional roller coaster that once dominated every trading session slowly begins to disappear. Trades are no longer driven by fear or greed. Decisions become calmer, more structured, and more deliberate. The market still moves unpredictably. Wins and losses still occur, but the trader is no longer pulled violently between emotional extremes. Instead of reacting impulsively to every movement on the chart, they operate with patience, discipline, and clarity. And that quiet shift in mindset is often the moment when trading finally stops feeling like a chaotic battle of emotions and starts feeling like a controlled process where consistency replaces impulsiveness. And the trader finally steps off the roller coaster that traps so many others. standing on solid ground with a clear system, a calm mind, and the understanding that long-term success in trading belongs not to the most excited participants, but to the most disciplined ones.